Today's Talk About It Tuesday question is, what are ways to avoid capital gains tax besides the 1031 exchange? All right, so I'm going to warn you now, you might want to pause this and get something where you can take notes because it's going to be a lot and I'm about to take you to school on this one. All right, so let's get into it. Where do we start? So let's just address the question, capital gains taxes. Most people have no idea that there are different tax rates at all because most people pay earned income taxes and that's it. So let's just talk about the three tax rates first. You have earned income tax rate, which is taxes that are paid on your gross earned income from a job or as an independent contractor. That is the highest tax rate that we have. It ranges from 10 for the lowest income earners all the way to 37% for the highest income earners. And they tax to your gross. So whatever you make gets taxed at 10 to 37%. Then we have corporate tax rate, which business entities, corporations, LLCs can pay, and that is fixed at 21% of the net earnings. So what's the difference? A corporation gets to spend all it needs to spend on whatever is ordinary and or necessary in the course of doing business. Whatever is left over, if there is a profit, whatever is left over, it pays taxes only on that amount at the fixed rate of 21%. And then we have capital gains taxes. Capital gains tax comes in actually two different forms. You have short-term capital gains and you have long-term capital gains. So what is the difference? Capital gains taxes are paid on any asset, that you sell, right? Not that you own, right? So let me explain that. So assets, and assets can be collectibles, it can be stocks, it can be bonds, it can be real estate, it can be land, it can be all these things that we consider capital assets. You pay taxes on what we call realized gains, right? So again, it could appreciate in value on paper. You can buy a stock at $20, it then go to $50, and at the end of the year, you don't pay taxes on that because you didn't sell it, right? So when you sell an asset, you pay taxes on the difference between the price you sold it for and the adjusted basis. So what's the adjusted basis? The adjusted basis accounts for any depreciated value, right? You get to subtract that, and any money that you put in for capital improvement. So anything you put in to make it better, to improve it, or any depreciation, you get to subtract that amount, then you pay on the capital gains. So now what's the difference between short-term capital gains and long-term capital gains? If you hold an asset for 1 year or less, right? If you sell it within that first year of ownership, that is considered short-term capital gains, and you pay a much higher tax on that. You will pay whatever your earned income rate is. So that means it can be as high as 37%. So you'll pay between 10 and 37%. So wherever you fit in your earned income rate, that's what you'll pay for your short-term capital gains tax. If you hold that asset for a year and a day or longer, then you pay long-term capital gains taxes if you sell it. Again, not on unrealized gains. It is a much lower tax rate, and it is a range from 0 to 20%, right? So 0 for the lower income earners, and it's not even really that low. It's about in the high 40s, maybe 47, 48,000 as an individual, and like 90,000 joint. If you make that amount or less, you pay zero taxes on your capital gains. If you're a middle income earner, and I think it's less than like $500,000, right? You pay 15% on your long-term capital gains. And then the highest income earners, the mega rich, would pay 20% on their capital gains if they sold it, right? So most people fall into the 15% range. So you will be paying, the lowest 15% capital gains if you hold. And that's one of the reasons that I tell people all the time. I don't trade stocks. Trading stocks is short-term capital gains. So whatever you're getting, you're going to give back in taxes. I don't flip properties because flipping properties, you're going to pay, again, short-term capital gains. So let's just get into it. The first way to avoid paying capital gains tax is to hold on to the asset. And some people say, well, if you hold on to the asset, how do you profit from the asset? I like to buy, and I'd say at least 90% of my whole portfolio of assets are income earning assets. I have mostly dividend stocks. I have interest income. I have real estate that pays me rent. Of course, I get capital appreciation out of all these things, and of course, that has value, more value to me as a way to borrow against it. But I'm not selling the assets, right? I'm getting income from the assets, so I avoid paying the capital gains tax. As even if they grow in value over time, I'm getting income from them, so I don't have to pay capital gains tax on those things because I'm not selling them. In my mind, if you acquire assets, you should hold on to them at all costs and try not to sell them because now you lost the asset and have to start all over. Assets should be things, in my mind, that provide you income, and then you can just pass them on to the next generation to give them a boost in their lives. So again, the number one strategy is just to hold on to the asset. Now, the questioner mentioned aside from a 1031. So those of you who don't know, a 1031 tax deferred, and it's again tax deferred. You're never going to avoid, if you sell an asset, you will pay taxes. The question is, can you defer the taxes? Can you minimize the taxes? So a 1031 tax deferred exchange only refers to real estate. If you have a piece of real estate and you sell it, there is a window in which you can acquire, right? If you take the gains, you can't pocket the gains, and you have to use 100% of the gains. If you acquire another asset, meaning real estate, if you acquire another piece of real estate of equal or greater value, then you avoid paying the capital gains taxes on that. You just put it into another asset. Of course, when you sell that asset, if you don't keep doing the exchange, you'll have to pay because then it'll be realized gains. So aside from the 1031 tax deferred exchange, we're talking about holding on, which is, like I say, to me, the absolute best strategy. There are, when you talk about securities, there are special accounts. I'll call them special accounts. That I'm not a fan of, right? You can get a 401k, right? So 401k we know is tax deferred, right? Because it's pre-tax income. Goes if you have a job, if you have earned income, it goes into an investment account. You can't touch until you're 59 and a half. But the problem is, and you do avoid capital gains because when you take it out, you got to pay an earned income rate. So I'm not a fan of that. Another way, Roth IRAs give you tax benefit, right? Because it's post-tax money. They don't tax you on it on the way out. The 529 college savings plan is not taxable because, again, it's post-tax income. So you don't get capital gains taxes on that. There are good tax benefits for that. Another strategy that some people use, so we said capital gains tax. So that means things appreciated in value, but some things depreciate in value. And what do we tend to do with those things? We tend to sell those things, right? Because they're losing money. One strategy that people do is when, let's say you have, some stocks or whatever, and they were not dividend paying stocks, and you decided you were going to sell a high performer at the end of the year to take the gains. You would also at the same time sell your losses because you pay capital gains on the net of your capital gains, not specifically on that investment. Meaning, if I had some things that lost and some things that gained, you subtract the losses from the gains, and on the net of that is where you pay your capital gains. So some people try to balance that out by anytime they're going to buy, they sell something that was also losing. So that's a strategy, but that assumes that you were losing something at the same time. I think, let me see. Yeah, those are pretty much the strategies when you're talking about deferring or minimizing, taxes. So again, I just say hold on as long as possible, and because there's no tax on unrealized gains. And again, if you can offset your gains in different ways with losses, with depreciated value, with what you paid. Oh, and there's a home exception, right? So home sale exception. If it's your home, it's not considered the same thing as an investment property. So I believe it's $250,000. I'm pretty sure $250,000 exclusion for if you're a single person filing single, and $500,000 if you file jointly. There's the home exclusion. So even if you bought your house at $500,000 and it appreciated to $1 million, and you filed jointly, they'll exclude $500,000 of that. So that puts you at zero. You wouldn't pay capital gains taxes on that. So again, as an individual, you get $250,000. As a couple married filed jointly, you get $500,000 exclusion. So that's another thing that most people don't think about. So those are the different ways that you can avoid, and I shouldn't even say avoid, defer capital gains tax. But if you sell an asset, you have to pay capital gains tax. And there are it's a different rate. I didn't really get into it for collectibles, by the way, which is a little bit higher. So collectibles are art and coins and things like that. They're considered a little bit different, and there's actually a higher rate for capital gains taxes on that. Not super high, but a little higher than other assets. So I hope that was helpful for you. Hope you learned a little something. I'd like to hear your stories of what you would do if you have a different strategy. But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.